Hey everyone, Luke here. Today we're going to be breaking down 3 stocks that are benefiting from the trend shift to more employees than ever before working from home. Before we dig into that though, let's take a look at an article I read the other day from The Atlantic. There's a link below in the description if you want to check it out, but it's called "Work from Home is Here to Stay," and that's the debate with this article is, are more employees going to keep working from home? And if so, these stocks will continue to benefit. And the article is quite good. It uses a lot of research and various other things in the article, and it talks about how employees, when they receive a perk such as the ability to work from home, then they're reluctant to give that perk up. Now, some employees are less productive at home while others are more productive, but ultimately on average, claims a study in here that says most employees were actually happier. Combine that with the fact that companies, I think, may recognize how much money they can save if they don't need things like office spaces, then I think you have a compelling argument that a lot more employees could be working from home for the foreseeable future. So let's dig into the first stock here, which is, of course, Zoom. Now, I did not include Zoom in the first article because I thought it was too obvious, but here in the second article, it would seem almost egregious not to include it. So I've pulled up their SEC filing, so I'm just going to go to their latest 10Q quarterly report. Let's turn off these tags here, and then let's scroll down, and we're going to take a look at the balance sheet. Now, what I want you to look at here is their cash balance, which has increased to almost $500 million, and then they have another $616 million in marketable securities, which is, I consider, basically cash. So they have over $1 billion. That's up quite a bit from January 31st. As of April 30th, they had about $1.1 billion in cash and marketable securities. There's not too much else on here that I want to point out. Just maybe note the increase in total assets. It went from about 1.3 to $2 billion, but so did the liabilities here. Overall, I think it's a pretty good balance sheet. It's not the best I've seen, but it's far from the worst I've seen as well. Total stockholders' equity down here is about $900 million. Let's take a quick look at the income statement for the quarter. So you can see here, revenue of $328 million. That was up a lot from the first quarter of 2019, where they only did $122 million in revenue. So they pretty much almost tripled revenue. Now, their gross profit as a percentage of sales did decrease here, because if you see 98 million almost divided by 121 million, it's going to be a lot higher than 224 divided by 328. If we take a look down the income statement here, they spent more on R&D, which is always good, a little more on sales and marketing. Both of those approximately doubled. A bit more than that on general and admin. And that ultimately gets us to income from operations of about 23 million. Flowing down to the bottom line, they did 27 million in net income. Note that this operating income line here is actually quite a bit less than net income. You don't usually see that, but that would be because of these items here, which are interest income. So that's going to add to operating income, and then provision for income tax took a little bit out, and that ultimately led to 27 million in net income, which is about 10 cents per share or 9 cents per diluted share. If you've seen Zoom's stock price, it has absolutely taken off this year. It was around $60 to $70 at the beginning of the year, and it's now $240. So if you've owned shares of Zoom, you've done well. But the question is now, are you going to continue to do well in the future? If we take a look at the valuation here, you can see enterprise value to revenue is a quite high 33, 34, depending on when you're looking at it and where the stock is trading, but recently that's approximately what it has been. That is quite high. You can see also it's a forward 1 year, so that's 2021 revenue that it's using. So it's enterprise to 2021 revenue of 26.5 times. That is still pretty expensive. And here's the problem with this stock for me. What is to stop Microsoft or Apple or Google or any of these other big companies coming in and creating a free product? In fact, Microsoft has Skype. Now Zoom has obviously overtaken Skype, but maybe Microsoft makes a push. They improve Skype to the level similar to Zoom. And then Zoom loses a bunch of customers because they get priced out of the market or something like that. I also have my doubts that Zoom is going to be able to maintain this growth rate going into 2021. Growth was already starting to slow before this pandemic hit, and then obviously everybody working from home needed a way to communicate with other employees and customers, so they all downloaded Zoom. But the stock, I think, is priced for perfection. They need to continue this growth for quite a few years, at least a couple of years. They need to grow 100% to maintain and justify this valuation, if you ask me. So it's a stock that I'm not willing to buy right now. Now, if the valuation got cut in half, I'd be a lot more interested if it was trading at around 15 to 20 times enterprise value to this year's revenue. I think that would be more compelling, but it's not. And so we just have to wait and see, or at least I'll be waiting to see with this one. The second stock we're taking a look at is PayPal. Now you might think PayPal, they're a customer-based company. What does that have to do with people working from home? Well, here's the thing. A lot of businesses receive payment through PayPal, especially online businesses. And I think people are probably going to look to start online businesses if they've been laid off, or they might look for at least a side income. With the economy not doing well, I think people might turn to alternative ways of making money, and they might receive payment through PayPal. In fact, it's pretty likely they'll receive payment through one of PayPal's apps. Now, PayPal also owns Venmo and a few other things, Zoom, which is ironic because I just talked about Zoom, but they own a different Zoom, spelled with an X instead of a Z. They also own iZettle and a couple other payment processing companies, all of which have varying degrees with businesses online that I think could become more popular as we see more people not only working from home, but with a worse economy. If we take a look at the valuation of PayPal, we can see that they're trading at an enterprise value to revenue of about 9.5. While that's getting a little up there, I actually think PayPal is pretty fairly valued. They might be getting a little overvalued here. I think the stock was up again today. Let me just check that. Yeah, so they're up 2.5% today. My discounted cash flow analysis, which might be coming out in another article on Seeking Alpha, shows that the company's worth about $166 per share. And as of the time of recording, the stock's trading about 168. So it's a little above my fair value, but you can always place a fair value range on a DCF analysis because there's a lot of assumptions built into a DCF analysis. So you could go plus or minus as much as 20% probably, which puts a fair value range somewhere between about $140 and maybe even as high as $200 per share. Now, PayPal is definitely one of the ones in today's video that I'd be most likely to buy. I think it's a strong business, although they do have some competition from companies like Square. Ultimately, I do think they will continue to do well. I think they're priced for very decent returns, nothing crazy, but I think they could probably outperform the market. I've taken a look at their free cash flow, and that is growing nicely. which I like to see. I love to see free cash flow growing as opposed to other metrics that aren't, in my opinion, as meaningful, like earnings. Now, just a couple more points on PayPal. I brought up their Q1 earnings, Q1 2020 earnings results here, and you can see free cash flow increased to $1.3 billion, which was up 60% year over year. And you can see here it's just a steady trend upwards, which, like I said, I love to see. Total payment volume increased 19% per year. Revenue grew 13%. Total active accounts up 17%. It all looks pretty good to me. Now, GAAP EPS was, or I guess that's non-GAAP EPS, was flat year over year. GAAP EPS was down. Now, what was interesting in the Q1 conference call and their reports, PayPal had a really strong April after a pretty weak March, meaning the rebound in the economy so far has definitely benefited PayPal. And I think my thesis of businesses moving to online, not only moving to online, but more people receiving payments through PayPal for work they're doing online, is definitely showing an effect here with their April numbers. Finally, we're looking at Ring Central. Now, this is a company I only recently discovered. This company does compete with Zoom as well as some other communication-based software platforms like Slack and Microsoft Teams. Ring Central is priced more reasonably than Zoom, although it's more expensive than Microsoft. It's approximately the same price as Slack, and I would say Slack is probably their closest competitor. We can see from this chart here that Ring Central's enterprise value to revenue going forward is about 20 times. That is getting up there, but it's not extreme. It's certainly not as high as Zoom, but it's definitely also not the cheapest it's ever been. That is comparable to Slack's enterprise value to revenue, which I think is pretty reasonable. It's a bit above Microsoft, and like I said, quite a bit below Zoom. Now, the company did post impressive growth in Q1 2020, and they raised guidance for Q2, but it remains to be seen whether this company can compete with some of these huge competitors. You can see here I pulled up Ring's balance sheet. Let's just take a quick look at this. Cash and cash equivalents. Whoa, that's a big line I just drew. Let me fix that. Cash and cash equivalents of 762 million, up from what they had in December. That's nice to see, although you don't want too much cash in a business. That's probably reasonable for a $25-ish billion market cap company. Looking at some of the other things here, not too much is jumping out at me. Total assets of 1.8 billion, so that's more than Zoom. And let's scroll down a bit here. We've got to get rid of those arrows. On the liability side, again, nothing really standing out. They do have these convertible notes of about $1 billion, so that stands out. Those will probably be convertible to shares, which of course will dilute shareholders, and so existing shareholders at some point will be diluted. If you wanted to learn more about those, you could probably find them in the notes to the financial statements in the latest quarterly report. Overall, I think Ring Central has a pretty reasonable balance sheet. Plenty of cash. The debt, maybe those convertible notes, it's a little iffy for me, but it wouldn't cause me not to buy this stock. Taking a look at the income statement, we can see here total revenues increased quite nicely in Q1. Let's just do some math and calculate what that percentage is. If we bring up a calculator here, 267, we're just going to round for the sake of speed. Mine's about 201. 66 divided by 201. It's about 33% growth. That's certainly enough growth for me as a growth investor. But then let's keep going down here, and we can see a net loss of 60 million, up from 60 million, or up from 6 million the year before in 2019. I don't like to see increasing losses. For the most part, I'm a profitability growth investor, so I like to see profits increasing and free cash flow increasing. So that's not the best thing for me to see there. And obviously per share, that's a 70-cent loss per share. Now, if I believe in some of the reports, they report non-GAAP earnings, so you could take a look at those, and I believe those are positive. But I ultimately wouldn't rely on those unless you really know the accounting rules here, because going from GAAP to non-GAAP, sometimes they can take out things that they maybe shouldn't take out. So in the end, I think Ring Central is an okay stock. I'm probably not going to buy it. If it fell quite a bit, then I might be interested, similar to Zoom. The most likely stock I would buy today that I covered would be PayPal. So I hope you enjoyed. Make sure you hit the like button and subscribe if you did. If you want to see more, let me know what you want to see. Do you want individual stocks? Do you want more multiple stocks like this one? I can do basically whatever. I am trying to put more of these videos out, so stick around, subscribe, like the video, and I'll see you in the next one.